Today, the property crash is just getting started. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. So following the Reserve Bank's double rate hike, the big banks have lifted their variable mortgage rates by 0.5 percentage points. As a result, the average variable borrower have seen their rate rise by 1.25 percentage points since the start of May. That means that someone with a $500,000 mortgage with 25 years remaining will see their repayments increase by an estimated $333 in total across the three hikes, according to Rate City. While variable rate borrowers with loans from CBA, NAB and ANZ will be charged a higher interest rate starting today, it'll actually take weeks for their monthly repayments to rise. In fact, the increase in monthly repayments that many of those customers are seeing are from the May hike. This is because banks typically give 20 to 32 days notice before lifting their monthly repayments, despite charging their customers the higher rate from the effective date. Even then, the increase to their monthly repayment may not take effect for another few weeks, depending on when they are due. So Rate City compiled the Big Four banks' minimum notice periods for rate rises for principal interest customers. For CBA, it's at least 20 days notice from the date of the customer's notification letter. At Westpac, it's at least 30 days notice from the date of the letter. NAB, it's at least 32 days notice from the date of the letter. And ANZ, it's at least 30 days notice from the date of the letter. And Rate City said that while RBA's rapid-fire rate hikes have rattled consumer sentiment for months, it's yet to show up in official retail spending data. Part of this could be because homeowners have only just started paying extra on their mortgage as a result of the first rate hike back in May. The latest surveys from Westpac and ANZ show that confidence is in freefall on the back of rising inflation and interest rates. However, people are still opening up their wallets at the shops, although this is unlikely to last for long. According to the ABS retail spending data for May, there was a monthly rise of 0.9%, up 10.4% year over year, but NAB is now predicting a slight decline in June. While it's great to see the bank giving their customers plenty of notice, any borrowers with their heads deliberately in the sand might get a shock when the higher mortgage repayments start coming out of their bank accounts, Rate City said. If you've got a variable mortgage, pay close attention to the letters and emails your bank sends you. They should have your new mortgage repayments clearly listed and the effective date. And people with direct debits set up should make sure they've got enough money in their account to clear it. They expect the new lowest rate to be 2.84% once all the hikes are announced. So if you think you're overpaying, then now's the time to refinance before rates keep climbing, they said. But the effects are already beginning to show in some of the data. The first month of winter was one where value growth continued to freeze, marking Australia's sharpest slowdown in more than 3 decades. According to PropTrack's latest home price index, the median value of a dwelling in Australia over June was $716,000, reflecting a 25 basis point stumble in growth compared to preceding months and a 55 basis point drop since prices peaked in March 2022. This fall was driven entirely by capital cities, with the respective median value reaching $778,000 over June, a loss of 35 basis points month over the month. By city, Melbourne was down 61 basis points, Sydney was down 40 basis points, the ACT was down 23 basis points, and Brisbane was down 9 basis points. And these were the only reported declines in housing values over the month of June. Adelaide was 42 basis points, Hobart 26 basis points, Perth 12 basis points, and 8 basis points all reported growth over the same period, with the REA Group's analytics noting that housing within the former three is currently at its peak. And regional areas also reportedly grew over June, lifting by 2 basis points to reach $582,000. According to PropTrack, these figures indicate that there's a two-speed housing market. That's one being driven largely by cost. The biggest slowdowns have been in the most expensive markets of Sydney, Melbourne and the ACT, the report said. Affordable lifestyle regions of Brisbane, Adelaide, regional Queensland and Tasmania have continued to grow, but the slowdown is spreading to those markets, with Brisbane posting its first small decrease since the pandemic began. And PropTrack also said that conditions in the housing market have cooled at such a pace which is the sharpest slowdown in prices in more than 30 years. And this was confirmed with dwellings across the country now continuing to lose value, according to SQM research data, which reported an average loss of 1.1% nationally. According to the SQM data, the housing values found no respite, with all Australian dwellings dropping by 1.1% in the month to Tuesday the 12th of July. This fall was reported at its strongest, with housing, which fell at 1.1% over the same period, but by comparison, units dropped by 30 basis points. As Mortgage Business had previously reported, capital cities were a key factor in this nationwide fall in housing values. According to SQM's research latest data, the price of a house with an Australian capital city fell by 2.1% over the month, but units, however, reported marginal growth of 10 basis points. Sydney and Melbourne experienced the largest on-average dwelling loss of 1.9% and 1.6% respectively. And the Victorian capital was the only city to see declines in both housing and unit prices at 1.3% and 1.1% respectively. By comparison, Sydney saw a house price loss of 2.6%, while units rose by 70 basis points. Overall losses were observed across Brisbane, down 1.4%, Perth down 1.1%, Adelaide down 70 basis points, and Hobart down 70 basis points. Darwin and Canberra were the only cities to see complete growth in houses and units over this month-long timeline, boosted by a combined figure of 2.9% and 1.1% respectively. Units in both of the territory capitals were also noted as being the key catalyst for this month's boost. In Darwin, units surged by 8.3% during the month, the biggest growth reported during this latest research period. And Canberra also saw similar momentum, with the city's units lifting by 4.6%. That was the second highest increase observed by SQM research. According to CoreLogic, in the 3 months to April, dwellings in the Northern Territory city bumped up by 2.2%. So while these latest figures support the persisting trend of Australian property values sinking for the first time in years, they also reflect the bounds of growth reported for owners during the COVID-19 pandemic. According to SQM research figures, housing across the country was 15.7% higher than it was at this time last year, with capital cities reporting a rise of 5.2%. This growth is reported across the country, with Canberra reporting the highest momentum for capital city at 27.3%, followed closely by Brisbane at 26.8%, Adelaide at 22.7%, and Hobart at 15.1%. Sydney is at 1.3% and Melbourne at 3.7%. And they also reported increase in the year to the 12th of July. And elsewhere, there are warnings that Australia's housing market could crash if interest rates rise too high after supersized increases in the past 2 months. Of course, the RBA hiked interest rates 3 times since May, taking it from a record low of 0.1 percentage points to a 1.35% rate. The Swiss investment bank UBS has predicted interest rates will peak at around 3.5% in March next year, but said this will still hit the housing market hard. We still think market pricing of around 3.5% if delivered would likely crash housing and see the economy nearing a recession, George Thananou, chief economist at UBS, told The Australian. If interest rates were to rise to 3.5%, it would likely see the average variable mortgage rate hit a whopping 6% and could plunge the economy into recession, according to the investment bank. Interest payments across the economy next year for the household sector will be close to double that from now. We've never seen such a sharp increase in repayments. That really crushes household cash flow next year when you have costs of living issues. The average Australian homeowner could pay an extra $991 on their mortgage by the end of the year, they said, if the Reserve Bank of Australia passes on all its predicted rate rises. And APRA required banks to stress test people applying for new loans by 3% above the current interest rate from November, but rates above 6% would be well above the test for millions who had taken out a mortgage earlier. And major banks such as Westpac and NAB have predicted interest rates will rise to 2.6% by the end of the year, while Commonwealth Bank has been more conservative, pegging it at 2.1% by the end of 2022. But meanwhile, ANZ has forecast interest rates to climb to 3.1% by February 2024. Rates were increased in May for the first time in 11 years in response to spiralling inflation, which hit 5.1% in the March quarter, setting off economic alarm bells. And experts have explained the need for the rates to rise since then, saying that the RBA is attempting to allow the economy to recover from the impacts of COVID-19, war in Ukraine, the New South Wales and Queensland floods, and the energy crisis in Australia. So a couple of observations here. Firstly, it's actually quite hard to get a good read on where home prices are actually trending. The different indices are actually telling us quite different things, but nevertheless, pretty much all of them are now indicating downward movements, and the rate of change of downward movements is definitely increasing. The second point is that rates, it is dead right insofar that many households have yet to feel the full impact of those rate rises because there is actually a delay before those bigger debits come from their accounts. That will happen over the next month or so, and more rate rises are expected, of course. So the lag effect is probably between 1 and 2 months. The third is that the data relating to house prices is lagged. It's lagged because often settlements are somewhat down the track, perhaps 6 to 8 weeks, and many of the indices don't take that into account, or they take data from asking prices which do not necessarily track settlement prices that clearly. So we must, I think, hang on to see how far home prices go, but if you add in higher inflation, the rising interest rates, the fact that there's more properties being listed, I think that we have yet to see the full effect of any correction to home prices ahead. Now, how far they drop, of course, is the big question, and I have different scenarios to cover a range of outcomes, from a very shallow adjustment through to a significant crash. But it does seem to me that commentators are now beginning to come around to the view that the crash end of the spectrum is a more likely outcome. I guess we will watch and wait. It's all down to the RBA, and the question then, of course, is does the RBA take house price falls into account when they set interest rate policy? Well, officially not, but unofficially, of course, they will. And that actually may put a cap on how high RBA rates go and when they start dropping them again. Very interesting times. Watch this space. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.